Here, another live video. It's two today, but I'm getting a lot of questions on YCC. So if you follow me on my Twitter account at Frank Curzio, a Curzio Research YouTube page, even if you follow on our site, CurzioResearch.com, we're talking about YCC a lot. I'm getting a lot of questions exactly what that means. And I want to show you why it's so important, why this is a big deal. So I'm going to bring up a chart here. So YCC stands for yield curve control. And what that means, first of all, you can see the chart from 41, 42, 43, all the way back here. This is a Fed measure that they set a specific target for interest rates. It's a yield target. And then the Fed commits to buying whatever amount of government securities need to maintain this target. So in contrast, what you guys are used to is quantitative easing, right? The Fed fixed the amount of monthly purchases under a regular program, which again, you know as QE. Now, I'm bringing up this chart because the Fed has only done this, guys. They've done this one time in history. Only one other time yield curve control they used as a tool to stimulate the markets. And this was back in 1942. So you could see the chart here where they capped rates at 2.5%, which is the yellow line. So if you look at that yellow line, see it stayed below 2.5%, which is very low back then. And the blue line is the market. Look what happened to the market when it started and asset prices took off, right? Now, again, this only happened one other time in history. Now, when we bring up another chart, you can look at real estate prices. Look what happened to real estate prices. Not only did they surge, right, from here to here, right here, right? But now, even after this, and this is a long period, guys, it's a 10-year period. You're saying, wow, stocks are going up. They're going higher. Interest rates are low. This is different. This is capping the rate. Why is that so important? Because the markets are forward-looking. And if the Fed does this, and I'm not the only one that believes they're going to do this, maybe they announced the September quarter. They talked about it in their minutes and said, we're not there yet. It's not the September quarter. It's probably going to be the next quarter. But you're looking at Scott Minerd, one of the greatest bond investors of all time, Jeffrey Gundlach, another one. Both of them are also predicting this. They've mentioned that, yes, this is a possibility that the Fed is going to do this. Now, what it does is it provides a long-term outlook on the markets. The markets are always forward-looking. The biggest threat to the markets is interest rates start going higher because we have so much debt. We all know the trillions of dollars going into the market. So if they decide to do this, it's saying long-term that we're going to keep interest rates low long-term. It's almost like a guarantee, as close as it's going to be. You're going to see the riskiest assets surge, just like they normally do in bull markets. They haven't done in this market, and I'll show you. If you're looking at the underperformance between Russell 2000 S&P 500, I mean, this is the worst it's ever been in terms of being oversold. The Russell 2000 oversold to the S&P 500. I went back to, this is 2014 Wells Fargo, but I went back even a few more years. I couldn't see anything like this, but you could see how the Russell 2000 underperformed and still is underperforming significantly. They're oversold the S&P 500. If the Fed decides to do this, you're going to see risk assets explode. And that's the point of YCC. Even if it doesn't, you're going to see small caps catch up a lot. Usually they do in markets where you see a bull market like we're having now in stocks, not in the economy. We all know things are tough in the economy. But it's very important to pay attention to this for your portfolios, guys. That's why, this is why YCC can make or break your portfolio. You want to position yourself, and I like to say buy the garbage stocks, but the casinos, try to pick a good casino stock, a travel stock, an airline, a cruise line, because as COVID gets better, remember how much money is flooded into this market. The difference between Main Street and Wall Street continues, right? So, the Fed's going to be there. They're going to continue to stimulate this market. And yield curve control, if they put that in, it's going to show long-term that rates stay low, very, very long-term. The last time this happened, the markets exploded higher. I know they're at all-time highs, and you're saying, whoa, holy cow, I don't know if I want to buy here. Use stop losses in case I'm wrong, because I could be wrong. However, when you saw the Fed do this the last time, I think they got announced this either the next 3 months or the next 6 months, you're going to see a lot of these risky assets explode higher in small caps. You want to learn more about this, we have a video on our page. It's at CurzioResearch.com. Again, if you want to look at it, you look at it. Not, but it's a 15-minute video. It's like a 13-minute video right here. You just have to click this 13-minute video. Yes, we're talking about a Curzio Venture Opportunity product. We're selling it at a discount. If you want it, you want it. If not, but pay attention to this. It's a very, very big deal. We're really pushing this issue. And even if they don't, we're going to see small caps go a lot higher. They're underperforming and playing catch up, especially as that COVID risk starts declining. But if yield curve control, the Fed actually does this and showing long term for a very long time, we're going to keep interest rates low. You're going to see the markets explode higher, specifically small caps. So definitely, definitely pay attention. Frank Curzio, as always, I'll be back to you guys soon. Take care.